Hey, welcome back. It's Noel Mathias from Mortgage 360, and today we're giving you your mortgage update for February 5th, 2021. And this is a 5-minute Friday, so this is going to be a fast and dirty episode where we're basically going to get you the information that you need, what the lowest rates are in the industry, and what we're recommending. At the very end of this video, I'm going to contrast the 10-year fixed with a 5-year fixed mortgage, so stay tuned for that. You might be surprised which one I will recommend. Actually, I don't even know what I'm going to recommend, but we'll see what happens when we get to that point in the video. But before we get into it, do me that favor, hit the subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their monthly mortgage or rent payment just for subscribing to this channel. It's free, it's easy, and it's definitely worth it. Okay, so let's get into it. Let's discuss interest rates for February 5th, 2021. And we really haven't seen many changes from our January rate update, but we want to make sure that you definitely have the latest updates and the latest rates. So when it comes to discounted mortgages where you are putting less than 20% down, so in other words, you have mortgage insurance, or you're putting more than 35% down, so you're basically having a low risk mortgage for the lender, on a 5-year fixed right now, you can get 1.44%. Now, if you want to go with a variable rate, you can get a 5-year variable at 1.3%. Now, one thing to keep in mind is these are the discounted rates. So when you get a discounted mortgage, you get what you pay for. They come with terms, they come with restrictions. Some are different than others. The main one to watch out for here is what's called a bona fide sale clause. That is the clause that means that you can't switch to a different lender or refinance and go to another lender or basically pay out your mortgage until the mortgage comes up for renewal. So be wary of that, especially if you're taking a variable rate mortgage, because if at some point in the next 5 years you decide you need to lock in, a bona fide sale clause could make it so you're put in a situation where the lender can say, hey, you know what? You can't go to a different lender, so you either need to ride out this variable rate or we're going to charge you a significantly higher lock-in rate than we otherwise would because quite simply, you don't have the option to leave. So you lose a little bit of your negotiating power there. Now for a discount rate with between 20 and 35% down. Remember, these are the riskiest mortgages for the bank because they don't have insurance and it is their highest loan to value exposure. For that discounted rate on a 5-year fixed, you're looking at 1.64%. And on a 5-year variable, you're looking at 1.4%. So now let's get into the mortgage that the majority of our clients take, and that is the non-discounted mortgages. These are the full-featured, full prepayment privileges. Leave if you want. All you have to do is pay a penalty to get out of the mortgage with these guys, and these provide the most flexibility over the term of your mortgage. So this is by far the type of mortgage that the majority of Mortgage 360 clients get. And for that insured and 35% down mortgage, you're looking at a 5-year fixed rate of 1.64%. This is actually lower than it was last week or last month in January when it was 1.69%. So that rate's getting a little bit better. And then on a 5-year variable, you're looking at 1.5% or prime minus 0.95, which is a pretty good rate. But these discounts keep getting better and better and better. So if you've got a possession that is a month or 2 or 3 out, there's a very good chance this rate could go down even further over the next couple months. So watch for that. If you're in the process of getting a mortgage, make sure that you're continually watching interest rates right up until your closing date. If you're a Mortgage 360 client, we'll watch those for you, but you want to make sure that you take advantage of any drops between when you apply and when you actually get your mortgage. Now, as far as that 20% down to 35% down range, again, the more risky mortgages for the bank, you're looking at a 5-year fixed in the range of 1.89%. This is, again, fully featured mortgage, which when you're putting 20% down or more, you definitely want to make sure that you have a fully featured mortgage. For a 5-year variable, you're looking at 1.7% or prime minus 0.75, which historically, really good rate. And then we get to that 10-year fix, that rate special that's out there in the industry. And right now, if we're looking at this from the perspective of 35% down or an insured mortgage, you're looking at a rate between 1.94 and 2.24, depending on the lender that you're dealing with and depending on the broker that you're dealing with. Now, here's my thing about the 10-year fix is right now, if I can get the 10-year fix close enough to a 5-year fixed rate, I might recommend that somebody take a 10-year fix over a 5-year fix, because what I'm worried about is I'm worried about when interest rates do rise, somebody who's in a 5-year fix having to renew into higher interest rates. But in order to make an informed decision about that, you need to understand what the difference between those rates means. So right now, if you can get a 5-year fixed at 1.64 and the rate on a 10-year fix is 1.94, that means it's going to cost you about $300 more per year per $100,000 in mortgage. So for somebody who has a $400,000 mortgage, you can basically bank on the fact that you're going to pay somewhere in the neighborhood of $1,200 more per year. And over the 5-year period, that means you're probably going to pay about $6,000 more to get a 10-year fixed. So the question then becomes, is paying $6,000 over the next 5 years enough of an incentive to take the risk and take a higher interest rate mortgage with a 10-year fix in order to make sure that when the mortgage comes up for renewal in 5 years or 5 years down the road, you aren't going to have to renew into a higher interest rate? And I think for most clients, if you consider what somebody can do with $6,000, keeping that in your pocket or putting away in savings, I'd rather see somebody take the lower rate and put it away in savings. But each individual has to make this decision for themselves and understand that basically it's a $6,000 insurance policy against rising rates. And if you genuinely believe that interest rates are going to go up a ton over the next 5 years, then maybe it's something you should look at. I'm still a big fan of the variable rate because I don't think that interest rates are going to go up substantially over the next 5 years. They may, I might be wrong, but I think that there's definitely some benefits to taking a variable rate and locking in a pretty significant amount of savings over a over a 5-year fixed or a 10-year fixed. But that is a decision that each client needs to make on their own and for themselves. Just make sure that you look at the numbers and the actual difference in the cost when you go to make that decision. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where all you have to do to enter is hit that subscribe button. We'll see you in the next video. Hope you have a great day, and we'll talk to you soon. Cheers.